Good afternoon, everybody. Thank you for selecting our session. My name is Lou O'Halloran, and I work with the Australian Environmental Grantmakers Network as their finance sector specialist. And in a former life, I was the Group Executive Director at the Responsible Investment Association for 11 years. It's my great pleasure to introduce you to the speakers of this session. This session was designed because I think at the end of 3 hours this morning, the question still remains, how on earth do we do this? There's a process behind it. There are serious investment decisions to be made. And so I asked two people who have on-the-ground experience with this to take us through, number one, a process of selecting investment methodologies that relate to the Australian stock market, and how one might divest from what we call Tier 1, Tier 2 companies. Companies with high fossil fuel exposure, some companies that are much larger, but also with a considerable holding in fossil fuels and in carbon intensity. And so we are going to look at quite a granular analysis of that, and I hope it really helps to answer some of these questions about why and how. Secondly, we're going to be speaking with somebody who's actually gone through this process at the University of Sydney. So without further ado, and then we're going to have 15 minutes of conversation at the end. So without further ado, I'm going to introduce our first speaker, who is Trevor Thomas. Trevor is the Trevor is the Executive Director of Ethivest, where he has worked since 1997, which is a very long time, isn't it? He's also a trustee of the John T. Reid Charitable Fund and the McKinnon Family Foundation, and also a director of the Difference Incubator, which is for social enterprises in Melbourne. Prior to joining Ethivest, Trevor was 6 years in Paraguay in economic and community development, and before that he was an economist in the wholesale financial markets. His own super fund is fossil fuel free, as is mine, and he is signed onto the Divest Fossil Fuels individual pledge site, as I have as well. So welcome, please, Trevor Thomas.
Thanks, Lou. The only game I was ever any good at was basketball. And so I played basketball from the time I was about 11 through. My goal was to get past my 50th birthday, and I just made it. But as I got older and the young kids got faster and better, I found it more and more challenging. So I started to play at the high school around the corner with a few old-timers, which was a lot more fun. And it was a pickup game, and people would come along and play in different teams. And one night this guy came with his friend, and they came in a really nice car, and the friend was all Mr. Big Shot, but the other friend, kind of wore his cap low and was pretty low key. Anyway, he was on my team. His name was Mike, and so Mike and I were playing, and halfway through the game, Mike's 6'5", huge arms, but he's hanging around way away from the basket. And I said to him, Mike, we need you in there rebounding. I saw Mike's picture on the front of the Financial Review a couple of days later. I was probably the last person in Australia to yell at Mike Cannon-Brookes, who set up Atlassian, is now a billionaire. But he wasn't the guy I wanted to impress. The guy I wanted to impress was CK, who was this giant African-American whose forte, apart from long shots, was passing. He said, you get free, I'll find you. So one time, I cut to the basket. I was under the basket free. I didn't want to let CK down. He fired the strongest pass at me. I had no chance. It was going to put a hole in the wall. I'm 189. I'm nearly 6'3". I jumped as high as I could, got my fingertips to the ball, which floated gently in off the backboard. Nothing but net. The perfect basket. I don't know. There was stunned silence. Nobody knew if it was intentional. I'm not sure if it was intentional or not either, but I do know that if I did it 1,000 times, it'd never work again. All that's a very long way of saying I know a fluke when I see one. And the fossil fuel-free movement has been very lucky with its timing. As it's gained momentum over the last few years, it's coincided with a significant downturn in the fossil fuel sector, and whether it's a fluke or not, it's been very fortuitous, and it's really helped take the argument further. This is a graph that's available on the Market Forces website, and it shows the impact over the last 3 years of the fall in share prices. That the green line, which you can't see very well, is up 26.38%. That's not annualised. Over the last 3 years, that's the Morgan Stanley Capital Index. That's the world share market fund. The oil and gas index is down 15% there, and the coal index is down 47%. So it's been a very good time for those of us in the divestment movement to be talking about divesting and the financial risks. Yep, we've dodged a few bullets. This is fossil-free indexes. This is a senior executive from S&P, met with the people from 350 and had an epiphany and left S&P and set up fossil fuel indexes in the States, and they now run fossil fuel indexes. There are a dime a dozen actually in the States. But you can see over the last 3 years, there's been a significant divergence in the curves. So the blue line is the fossil fuel free line, and the grey line is the S&P 500, and there has been a significant opening up. You've dodged quite a few bullets by not being invested in Peabody Coal, as Tim Buckley shared with us this morning. The question is that impacts on those of us who manage capital or are responsible for managing capital is whether this is a cyclical trend or a structural shift. Tim made a very coherent argument this morning that this is structural. But it's very significant because fund managers generally are particularly concerned about tracking error, about how you're going to perform against your benchmark and your index. And if this is cyclical, then you would expect oil and gas stocks to bounce back. And if it's structural, you'd want to be out of the sector because it's going to hurt your absolute performance. So it's an open question, and it's one that is obviously going to exercise a lot of minds over the next few years. But at the moment, I'm pretty persuaded by what Tim's saying. Within the divestment, the range of divestment approaches, and there's a different approach for every organisation that makes the step, really. I have classified them into sort of 5 steps. It's a bit arbitrary, but there's the no action part of the spectrum where, and that about half the money invested in Australia doesn't have any E.S.G considerations taken into account by the investment managers, but the other half does. But there's the no action school. There is a disclosure, and this can be very powerful. It's only a small step, but you can ask your fund managers what your exposure to different things is. So on the John T. Reid Charitable Trusts, which is a 60-year-old Melbourne family foundation, we asked our fund managers just to disclose fossil fuel exposure, tobacco, gaming, a few other key ethical issues. And the very fact that we're asking the question is starting to change the conversation and have an impact. They've suddenly got to go scrambling through their books, and it's of interest to know what their clients are interested in because it's leading somewhere. The second step down that path is to screen out the high-intensity carbon activities. The third is to look at more comprehensive screening, not just high intensity. And the final there, the fifth, but the fourth of action is complete divestment. Now, I haven't paid attention in this to low carbon tilts and decarbonising portfolios and otherwise. I have looked simply at divestment. I'm happy to talk about the other things, but my brief was to look at divesting in practice, and I think that's the different approaches. So let's drill down into that, to use a bad metaphor. High intensity screening, you're only looking at direct exposure. So there's the companies that are directly engaged in mining fossil fuels, in producing and selling fossil fuels. Often that high intensity screening is by sector. Stephen Hines this morning talked about the fact that they started with tar sands and oil and coal, and then they were going to progress through other fossil fuels. So there are all sorts of different organisations that take a different approach, and we'll just highlight a couple of them in a moment. But there's a sector-by-sector kind of approach, and there's generous materiality. The big issue in ethical investment and screened investing is how big the mesh is in your screen, what can you drive through your definitions, and if you have a 30% tolerance, it means that 30% of revenues or profits can come from an activity you want to exclude, and that's a fairly generous approach in the market. And so if we look at how that's applied in practice, AMP, the Responsible Investment Leaders Fund, excludes companies with over 20% exposure to coal-fired power generation, the mining of thermal coal, oil sands, transport, exploitation, development, or from conversion of coal into liquid fuels. Local government super, Bill spoke this morning, excludes investment that make a third of revenue or more from carbon-sensitive activities. Hunter Hall excludes direct and material business involvement in fossil fuel exploration, production, refining, storage and transportation. Their approach was just to define the GICS index, the Global Industry Classification Scheme index that's related to fossil fuels, and exclude that. Christian Super excludes coal, oil sands, exploration and sale, and brown coal generation. That's more than 20% of revenue in a company's case. And Dimensional is launching an SRI fund in Australia soon, a screen fund that excludes all underground reserves of fossil fuels and tilts towards low emissions. So a range of different companies and different exposures and different methodologies. I want to say that all of them are valid. I think it's important that we reaffirm what was said earlier, that starting on the journey is really important, and defining where you're starting from and where you want to get to is important, but taking a few steps and joining in is starting to add momentum to the conversation, and by it allows people to make pledges and publicly recognise that that's the journey they're on. And so I don't want to pick fights with people who've got different definitions to me. I want to say good on you for anything that you do, and I think people that start small there'll probably be inertia and drive towards change. Comprehensive screening. This is the second kind of middle place. This is where people start to look at direct and indirect exposure, and cover all activities in the fossil fuel cycle. So not just mining, but also transportation and sale. And in this space, you're looking at tie to materiality. So people are starting to really say, well, if you're getting more than 5 or maybe 10% of revenues, this is the Tier 1, Tier 2, Tier 3, Tier 4 that Louise was talking about. Comes from research done by the Australian Institute, commissioned by 350 and Market Forces. And it shows there the companies in Tier 1 that are substantially involved in extraction. And so the usual suspects, I'm not sure if you can see at the back, but the sort of the Woodside Petroleums, Caltex, Cenex, Drill Search, Beach Energy, Whitehaven Coal, direct fossil fuel companies. The second, Tier 2, is substantial exposure, including generation and transport, so that's the pipeline companies. The third is where you start to get to diversified companies that have some fossil fuel exposure, like BHP, Rio and Wesfarmers. And the fourth is indirect fossil fuel exposure, which is where you're looking at the banks and insurers, the engineering companies, the companies that produce the explosives, those that their business model depends to some extent on serving customers that are directly invested in fossil fuels. And so how that pans out in practice is that at the ASX on Friday, at Friday's weights, Tier 1 direct exposure is about 3.9% of the Australian market. Tier 2, which includes the pipelines, is another 1.4%. And that's been pretty consistent over the last few years. If you've been excluding those direct investments, it works out at 5 to 6% of the Australian market. And so if you exclude those two levels, the tracking error that you're going to have against the index isn't too high, and that's what the figures show. I was talking to Eric Smith, who's speaking before the session, and he was saying, well, in Australia's stock market itself is skewed so heavily towards a couple of key industries, and if you step back and look at the world and screen out direct exposure, it's much, much smaller. And that's true, and there's a research house called Aperio, A-P-E-R-I-O, that publishes on its website regularly updates about its indices, and the tracking error that it has back over 10 or 15 years for excluding direct fossil fuel investments is negligible. It's almost invisible. It's only opened up a bit of tracking error in the last couple of years because the fossil fuel sector has done so poorly. Tier 3 is where it starts to get interesting. If you start to knock out BHP, Wesfarmers and Rio Tinto, they're all roughly 4% of the market exposure each. So you can't knock those companies out of your portfolio without having some impact on tracking error. Again, if this is a structural thing, you want tracking error. If it's a cyclical thing, you might be worried about it. Tier 4 is about 32%. So that leaves in the totally fossil fuel free, no exposure, about half the market, 48%, as at last Friday's numbers. So you've got a dramatically reduced universe for no exposure whatsoever. The interesting part about the yellow segment of the pie is that 82% of that is the 4 major banks and Macquarie. And I'm happy to go into chat about the bank's exposure because we think they're not all cut from the same cloth. And complete divestment, direct and indirect exposures, banking and insurance, which are the subject of debate, as I say. It covers all activities of the fossil fuel cycle, zero tolerance, so it's companies that want to play in, or select investments from half the Australian share market. And and future super, obviously, is in that space. Australian Ethical last year announced a fossil fuel divestment complete policy. And Ethivest runs an ASX Green 100, and as you know, I'm very happy to take the flukes when they come, so you can see the outperformance there, which is driven entirely by fossil fuel exclusion. Thank you.
A different approach to addressing climate risk, which is to look at the entire portfolio across all industry sectors and to look at a process of, let's say, underweighting. Greg Fernance has in excess of about 30 years investment experience across a broad variety of roles, ranging from fixed interest, portfolio management and investment banking, to his most recent role as the Chief Investment Officer at the University of Sydney, a role that he held there for about 12 years, until January 2016. He was the central architect of the University of Sydney's innovative approach to the fossil fuel divestment debate. And as a result of that work, in February 2015, Sydney University announced that it would set a target to reduce the carbon footprint of its listed share portfolio by 20% over the next 3 years. At last count, that applies to $237 million in Australian equities and $167 million in international equities, which is just under 1/3 of the university's total investment portfolio of $1.3 billion, excluding their property investments. So welcome, Greg.
Thank you.
And I think it's really fantastic that Greg comes to speak to us today, because Sydney University has probably been one of the landmarks on the divestment landscape in Australia. First of all, Greg, a little later I'd like to ask you at a more granular level about the 20% underweighting and what that all means, and how that affects the carbon intensity of certain investments as opposed to the whole portfolio. But firstly, I just want to ask, from a process perspective, how did this all start at the university? And probably, what was the first trigger?
Well, it was a small team at the university, and as I speak, I might just clarify the structure of the portfolio, some key aspects. We appoint external managers, and we use a consultant to assist us with that. In Australian equities, we're large enough to hold the shares in our own name, so we have what are called individual mandates, and the shares are in our name. But on international equities and all the other sectors, we're not large enough to have an individual mandate. So the E.S.G sort of push, if you like, started to emerge around, say, 2010, where in our manager selection processes, we were starting to ask questions in the due diligence phase about their ESG practices. We also were starting to use Mercer ESG ratings of the managers. They go 1 to 4. 1's good, 4's not so good. And by the way, being an endowment, and we were investing according to the US endowment model, we had a lot of private equity and hedge funds or absolute return funds, and ESG wasn't big on their radar. It's now increasing, but it wasn't big then. So we started to use the ratings. We didn't have a formal policy in place at that stage, but in 2013 we had our first formally approved investment policy, and it incorporated the ESG ratings and how we do due diligence on managers, and it set some targets for the weightings across the portfolio. But at that stage, we didn't have a specific climate change section in the policy.
Thank you very much. So when you went into that stage, and did you start then with, say, an information gathering process? What was the first step when you decided that that was where you wanted to go, or how did the carbon issue come up?
Well, there'd been a number of disasters on the horizon, and we were aware that of the risk potential of it, hoping we'd never be exposed to it, but we were certainly aware of it. We were also, I should have mentioned it, an early adopter of using a proxy voting expert, and that was applicable in Australian equities where we held the shares in our own name. So we could go to an AGM and we could vote according to our shareholding. So it just gradually emerged, and as more, I think some of the NGOs, I'll give them credit, they raised it on our profile, and they had a lot of sort of impetus towards the push to get something on climate change.
And if we were a fly on the wall in some of the board meetings where you discussed this process, I mean, how long did that process take in discussions? And was there a real diversity of views?
Stephen Hines spoke this morning. I can tell you I had all the problems that he had, and probably more. I think universities' endowments are probably the most challenging areas to deal with ESG. If you think about it, all the staff are potentially activists, all the students are potentially activists, and then you've got the philanthropists who are ex-students or ex-staff, and they are activists. And just quickly, when we were under attack after ANU had been under attack in its approach from Greenpeace and other organisations, I can tell you social media was running red hot, and there were letters coming from philanthropists, and they all write to one guy, or they send the social media to one guy, the Vice-Chancellor. So, and he can't deal with it all. But I did see, just a little digression, 2 letters from 2 philanthropists. One said, if you listen to these turkeys, I'll use that phrase, I'll never give you another cent. And then the other one said, if you don't listen to these guys, I'll never give you another cent. So you have the full breadth of the spectrum. And these are all important people that support the organisation. So somehow you need to come up with a framework that respects their interests.
And so what was the basis upon which you decided to move forward to that information gathering stage and deciding on the methodology? Did you get together a set of foundational beliefs or understandings? Did you all come to a consensus?
Well, I should have said in the other answer, there was a diversity of views across the committee, and I was aware of that. And I thought, how the hell are we going to get this group together? And it happened at the climate part happened at a time post the ANU saga, which was in the press heavily, and there was, my God, this is going to damage the reputation of our university unless we get it right. So we began with a workshop with our committee. We had to feel them out. What are their views? How's it going to go? And a workshop to us is a formal committee meeting, but it's outside of that environment. And you have one topic, really, not a full agenda of the usual meetings. And we had Mercer attend that meeting with us, and they used their CETA model, Sensitive Investment Topics Analyzer. And that got us part of the way, but there was still quite a diverse range of views. I won't go into the intricacies of the meeting.
Go on.
No, I can't. But at some stage, someone asked me, Greg, what do you want to do? And I said, well, I want to measure our carbon footprint and set a target to reduce it. And I thought that was a pretty simple idea, but when you think about what climate change problem is, it's about carbon emissions, and everyone and governments of the world are trying to agree targets to reduce the damn thing. So it was a very direct approach to it. I wanted to make a positive contribution. The university I knew there was a common belief across the committee of what you call an integrated approach, which means very limited divestment, and you use a broad spectrum approach to assess and deal with ESG risks. So that sort of seemed to hit a few or tick a few boxes, and we developed it from there.
Did anybody on the committee surprise you either way in their staunchness against or for? And did people change their mind in the process?
Look, I think they changed their mind along the way.
And what were the triggers for that?
I think when I put on the table a solution that it didn't directly pander to the one who said, I want you to divest. It didn't directly go to the one that said, I don't want you to divest. It was a broad-ranging solution that aligned with the cause and made a positive contribution. And that was the key. It covered, there was a little bit in it for all of the stakeholders, but no one got what they really wanted all up, 100%.
Which gets us to what did you end up doing?
Well, we decided that the methodology was sufficiently robust to measure our carbon footprint in our listed equity portfolios. Now, I said early on, a key to that was in the Australian equities, we hold the shares in our own name, individual mandate, and you've got more flexibility with what you can do there. But in emerging markets, we only had 2% there, and in international equities, you're around 12 or 14 at the time, but we were bringing that down to a target of 10. We're also in pooled mandates. So it really comes down to selecting your manager and understanding their philosophy as to how they pick their stocks, as to whether they might be sort of a green type of manager, if you like. But there's no guarantee with that when you're in a pooled mandate. And just to digress again on a related topic, one of the managers that we picked to go into the international equity sector because of their climate change considerations, so we sacked one manager and put a new one in. Within the first 6 months, they had outperformed the benchmark by something like 8%. And then around Christmas, when we published, and we have transparency, we published our top 20 stock holdings of each of the managers on the website, and they had tobacco. And we are a complete divestment on tobacco. It's a useless product. It hasn't done anyone any good in the world, and I can't make a case for it. So this manager was really good. It's going to hurt. And they were in there for climate change. But we actually terminated that manager because it was a pooled product. They weren't going to change for us. We had 2%, about 25 million in that manager. And even though they understood, they weren't going to reinvent that product for us. However, the good news is they are working on fossil-free mandates and things like that. But it wasn't available at the time. And to go over a December 31 annual reporting date and have tobacco in there, and our annual report goes into Parliament, was never going to happen. So we stuck to our resolve and we terminated that manager. So that was a digression, by the way.
And I'm going to digress too, because we were on an investment thread there. But from a reputational risk perspective, it appears to me that you were very exposed.
Look, we're in Australia. We're a resource-based country. And indeed, the transformation that we need to make now, in some sense, is not a lot different to when they used the phrase riding on the sheep's back. We were, a wool-based and cattle and sheep commodity-based country then. We now need to make a similar transition. The only difference, I think, this time is the whole world is kind of got the same problem. But for us, we are heavily commodity-based, and we've got to make that transition.
When you talk about a 20% underweighting, are you able to describe, for those of us who may not work across directly with portfolios and with investment, how might that impact, say, the Tier 1 companies that Trevor was talking about? Let's just talk about Australia. Tier 1 companies. Over 3 years, first of all, if it's 20% across the whole Australian equities portfolio, what might it be for those heavily carbon-intensive companies?
Yep. So I'll clarify the target there. We've set a target to be achieved over a 3-year period of having a carbon footprint. It's measured annually in September by Mercer do the measuring, but I think they engage either MSCI or someone who does that. And we measure it annually in September, and it's 20% below the benchmark for the sector. So let's pick an easy one. Say the All Ordinaries Index was the benchmark for the Australian equity sector. You can measure the carbon footprint of that index. Well, our portfolio, we would like to have 20% a lower carbon footprint than that benchmark. So over time, if the All Ordinaries Index suddenly gets energy efficient and has a lower carbon footprint, and we've still got a 20% below target, then it gets harder to achieve it. However, we didn't choose to announce 3 separate targets, one for Australian equities, one for international equities and one for emerging markets. That would have been very confusing. We decided we would set a blended target for the sectors in aggregate. So we're trying to achieve a 20% carbon footprint, 20% lower carbon footprint than the blended benchmark for the international equity sector, the emerging market and the Australian equity sector. Now, what's it mean for companies? It's simple. If you were to achieve that target, somewhere in your portfolio and across your portfolio, when you aggregate them all up, your stocks have to tally up to a carbon footprint 20% lower than what's in the benchmarks. So you can't get that position by holding the high carbon footprint companies, the tier ones as you call them. So you have to underweight them. It has to play out by default. But it doesn't mean that one manager who we might not have much money with is underweight them, but another manager that we have a significant amount of money with in the sector is significantly underweight. So varying contributions from each of the managers can contribute to achieving the target.
Are you confident about the measurements?
Well, you would have heard this morning from people who are much better in doing that stuff and know more about it. Dr. Max Horst, I've met him before. He's a bit of a guru in that space. MSCI, who've been producing indices for a long time, they're very good at it. And I understand the methodology is getting better. Together with the push, I don't think it's mandatory yet, but when we get a formal mandatory requirement for companies themselves to start reporting this based on a given methodology, the methodology needs to be reasonably standard. If you just have people invent their own methodology, it will be soft. But when we get to that point, I think we're in a much better position in terms of the measurement and transparency perspective.
Can I ask you how you arrived at 20%?
That was a bit of a feel figure. There was a lot of analysis done. Where are we now? You don't want to set a target that you didn't think you could achieve. That's just setting yourself up for failure and embarrassment. And at the same time, on the other side, what is a reasonable contribution? I was aware that certain green funds around the world, and I'll mention one by name, Generation Capital, the Al Gore fund. I'd been overseas the year before and I'd met with them and I recall from that trip they said that they had a portfolio that was 20% below. Now, I don't think I fed that figure in. I think the figure came from Mercer in the analysis that was done. But when they suggested 20%, I thought, well, that sounds good to me.
That's Al Gore.
Yeah.
That's good enough for me. And finally, final question for me, and then we'll open up to the floor and bring Trevor up too, to squash onto this deck with us. Is there any room in there for redirecting? Emma Heard said, the trouble is not doing that part of it because that's a fairly clinical exercise. I mean, it takes a lot of guts and it takes a lot of work. But the redirection, do you have any sense of how that's going to play out in this strategy?
Just clarify redirection.
Redirection of capital towards very low and innovative investments.
Well, at the moment, without a plan and governments floundering around, notwithstanding that Paris seemed to bring them a long way down the page, it's happening via default at the moment, which is potentially a recipe for chaos. But I think there's only a few steps that can limit that every man for himself approach. And one would be that requirement for formal reporting. That then puts the heat on everyone, and that might have a certain size. You might limit that to a certain size company. But a formal reporting would then give the transparency, and money can then flow based on the decisions of the analysts and that to what they think is the best proposition. At the moment, it's sort of...
You're saying you don't give it much chance at the moment because things are a bit opaque and it's hard to know.
It needs more guidance. It is happening, but it's happening by default is what I'm saying. Yeah.
Thank you very much, Greg. That was a wonderful chat, and I think really it's wonderful to get to that granular level of how these things play out over time. And we could have spent a couple of hours on it because you really want to get under the covers and figure out, who said what when and how you actually got to that position. But I think that's a pretty good overview of how it worked in one of our seminal case studies in Australia. So I'd like to ask Trevor to join us again on this squashy stage, and. I don't think I'll ask any more questions. I don't think I'll do a chair's pick. I think I'll just hand it over to the audience because we've only got about probably another 10 or 15 minutes left. I'll open it to the audience, and Beck has some microphones.
Actually, I want just to ask you to expand on your comment around finance, because we've got the big banks. We're all exposed to the big banks. So you were saying you do differentiate. So how do you differentiate?
It's around looking at the bank's position papers on their preparedness to address these issues and how deeply ingrained ESG practice is in their lending and investing. And I think, the researchers who look at the banks don't all come to the same conclusion, but see that there is a spectrum of responses. And so I know that Australian Ethical Investments and our own model includes Westpac at the responsible end. Not everybody will agree with that, but we think there is sufficient difference to be able to make that call. And we engage quite closely with all the major banks. We visit them all every year. We look at their sustainability reporting and how that pays through, and we've got the beauty of having highly motivated ethical investors is they're all mini detectives and agitators, and so they write letters and they go to their branches and they do all sorts of things, and we rely on the NGO community for feedback around lots of issues, and so we've made that call, and we have to defend that quite a lot, but it's really interesting to see the banks positioning themselves over time and taking active steps to improve their game.
Hi, Peter Sainsbury. I just want to ask about the structural cyclical issue a bit more. As far as, I can ask Trevor because he knows how ignorant I am about the issues, but it's not obvious to me why anyone would stay invested in a coal company when shares have plummeted so much. But my question is there an example of another industry whose share price has plummeted to the extent that the coal industry has to recover? Is there any ground whatsoever for thinking that this is cyclical?
Well, I mentioned Westpac. They were desperately short of money in 1991, scrambling at $2 a share, and saved themselves and bounced back strongly. So you can markets generally tend to overshoot, and so it wouldn't surprise me at all if, even though coal is in a long-term decline, that there are some signs of life down the track, and some aspects, as we were saying earlier, the most profitable power stations in Australia are the dirtiest, and the people who invest in those are making a very tidy return. So there will be pockets of good return. And so I think it's too early to say that the cyclical case has won. I think it's going to be cyclical, but I think it's probably going to bounce around, and if it bounces around, there will be a time. It'll be structural, but no, it will be structural long term, but the long term is who knows how far.
I'm also an economist, and I think about this a lot, and I can't get past this point, but I'll put it to you, and you need to assume a few things. Let's assume we didn't have the GFC, and let's assume that China hadn't slowed and it was still growing at 10%. Where would the coal price be? I don't know the answer, but we mightn't have had the big severe fall. If that's the case and China's slowdown is cyclical, then at the moment you'd have to say a fair chunk of it is cyclical. But I agree, the underpinnings of a structural decline are beginning.
Hi, Blair from 350. Question for Greg. How did the uni decide on the limit to which it would go for making the change? And did it put the university in a position to think of a step change to increasing that over time, knowing that, as you said, your faculty and your students are all potential activists who like what they've seen so far but would probably like more?
Well, this was a first step. As I mentioned earlier, the 2013 policy did not have a climate change section in it. We were working on it, but it just timing got taken out of our hands when the ANU thing occurred, and we actually had one of our managers had a small holding in Whitehaven Coal. It was so small, but we were getting beaten up by that. Bad, smart uni, dumb deal. Things like that. No one wants to see those headlines. So reputation damage was high up there. So as a first step, it really was, where are we? There was lots of analysis done on hypothetical portfolios. If we'd have done this, what would our return look like? Because the trustees of endowment funds, and if you might have got it from Stephen this morning, they're hypersensitive. If they don't deliver a good return, then the 5% they pay out every year is less. They can't, and what they're giving it to is really good causes. So they really are sensitive to try and deliver a good return, but not take too much risk. So it was feel our way, what is a reasonable contribution to make. Now, it is a first step. That target may change. We may decide at some point, if we get convinced that it is structural and we haven't been too late into the game, we may say, well, let's divest now. All those things are open. It was a first step. The committee meets quarterly, and it's a 3-year target, so we tend to review these things 3 yearly.
We've got time for just a couple of more questions. There's one up here, Richard.
Okay. Nigel Stewart, Dimensional Fund Advisors. My question is for Trevor and/or Greg, and it relates to the idiosyncratic risk. Once you pull out Wesfarmers, BHP, Rio, the banks and whoever else, it would seem to me that you're left with a fairly concentrated portfolio. I'm looking at the Australian context, not the global context. How do you deal with that idiosyncratic and concentrated risk?
We have the big advantage of having 500 idiosyncratic clients, so they see that as an advantage. But it's actually the core question for trustees and institutional funds management. Where do you position yourself and how do you start? And I think that it gets difficult in that tier 3 space where you've got Wesfarmers, BHP and Rio Tinto that are largely not fossil fuel companies but have a substantial holding, and you might want them for their other activities, but you're lumbered with this fossil fuel bit that you might not like. And so I think that those companies are sensitive to changing dynamics in industry, and I think investors can be part of the change in that story. So I think it's interesting that when BHP spun off South 32, even though it held coal assets, it spun off 75% of its carbon emissions. So it already was thinking about a post-Paris world and getting ready for, and came out publicly and said, we're ready. We won't be penalised in a post-Paris world because we've made these changes. And I think if fund managers start to make the changes in tier 1 and tier 2, the Wesfarmers, the BHPs, the Rios of the world will start to classify the risks around different fuels differently, and that will drive change, and that will mean that hopefully that green and yellow segment grow and create more diversified portfolios.
We only have 1 minute left, so
Sorry.
One quick question.
Richard Dennis from the Australia Institute. Quick question. I know it made the process more complicated, but did ANU divesting did ANU divesting make it easier for the institution as opposed to the decision makers to move? And Trevor, do unis divesting make it easier for you to attract business?
We might have been a beneficiary of having seen the way not to do it, and I think with all those negative headlines and that around ANU, there was certainly concern, gosh, we don't want that to happen to us. Something I didn't mention is that the universities have very extensive relationships with industry partners. So I think we have a massive sort of donation and industry partnership with Rio Tinto and others. So to simply go and say we're going to divest Rio Tinto, the academics would come after you with knives, because they provide a lot of funding for them to run their projects and to train engineers and things like that. So we had to be very mindful to come up with a solution that didn't cause the reputation to go the way of ANUs, and to try and deliver something that gave all stakeholders a little bit.
Thank you.
There's no question that the divestment movement has reinvigorated growth in the ethical investment space, and if you look at all the numbers and inflows, it's very significant, and divestment's contributing to that. Speaking at university divestment rallies creates great headaches for me, because I get thousands of calls afterwards that we can't help.
So I think we'll wrap it up there. I want to commend both of you for the work that you do, because this is what's changing the landscape and introducing new methodologies and possibilities. Just telling me to use the microphone. It's your work is introducing new frameworks and possibilities, and you're doing a little bit of tracking for us, and you're experimenting for everybody here in this room to go forward and I suppose start the process of looking at your own portfolio. So I want to thank Trevor and Greg very much for your time and your thoughts today. Can you please give them a hand? Thank you.